Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. This year, 2026, we're sharing 26 client profiles. These are not hypothetical examples. These are real people, real policies, real premiums, real health histories, and real expert advice. The only thing that's fake is the names. In the last episode, I explained how Steve and Marilyn were able to avoid paying taxes on Steve's cash value life insurance policy by transferring the cash value to a Pension Protection Act compliant annuity. That's a mouthful. The Pension Protection Act became law in 2006 and became effective in 2010. Since then, taxable gains in non-qualified annuities and taxable gains in cash value life insurance can be turned into tax-free long-term care benefits. This is done through a 1035 exchange. In this episode, we'll talk about Rod and Cassie and how they funded their long-term care coverage with one single premium and in the process avoided $40,000 of income taxes. Now, Rod is 54 years old. Cassie is 55 years old. Rod is a partner in a law firm. Cassie is a stay-at-home mom. They have a high six-figure income. They have a very comfortable seven-figure net worth, and they plan on retiring in a couple of years. Both Rod and Cassie have had some health challenges over the years. Rod had some back problems that required surgery and physical therapy. He also has a history of migraines and a history of major depressive disorder. Cassie has had a history of anxiety and depression, and one of the medications she takes is considered uninsurable by most long-term care insurance companies. Fortunately, about 30 years ago, Rod invested $25,000 into a deferred annuity. He had received a small inheritance and he put a portion of the inheritance into this annuity. And it has grown to almost $130,000, more than $100,000 of gain. But Rod and Cassie want to buy some long-term care insurance. If they withdrew the money from the annuity, they would have to pay about $40,000 of income tax plus a 10% penalty. We avoided the income tax and the penalty by doing a 1035 exchange. We moved the funds from the deferred annuity to a Pension Protection Act compliant annuity, PPA compliant for short. Should Rod or Cassie ever need long-term care, the withdrawals from the annuity to pay for long-term care will be income tax free. We turned taxable money into tax-free long-term care benefits. Now, many of my clients have cash value life insurance or deferred annuities that have grown a lot over the years. When I share this strategy with them, the first thing they always say is, "That's too good to be true." But it's not too good to be true. The federal government wants people to plan for long-term care. That's one of the reasons why the Pension Protection Act was passed in 2006. But you must be very careful. Not every annuity meets the requirements of the Pension Protection Act. Every annuity is not PPA compliant. You must use a PPA compliant annuity in order for the taxable gains to be treated as tax-free long-term care benefits. When Rod and Cassie's 1035 exchange came through from the other insurance company, the total value was a little under $130,000. So what did Rod and Cassie get for that $130,000? Well, if we look only at the guaranteed rates, if they need long-term care 10 years from now, they'll have a total long-term care benefit amount of over $500,000. And those funds can be used tax-free to pay benefits for either of them or shared between the two of them. The total long-term care benefits and the monthly amount are guaranteed to grow every year for as long as they live. If they both need care at the same time, each of them can receive the full monthly benefit. In other words, they don't split the monthly benefit. If they both need care, each of them can receive the full monthly benefit amount. What if they pass away without needing long-term care? Well, if they both pass away, let's say 20 years from now, without needing any care, their beneficiary will receive over $150,000 guaranteed. Basically, the original deposit plus a little bit of interest. Now, is this PPA compliant annuity a good investment? No. Like I said in the last couple episodes, it's not a good investment because it's not an investment. It's primarily an insurance policy to help protect their other investments from a potentially catastrophic long-term care experience. And if they never need long-term care, well, great. Then their beneficiaries could get back what they put into the annuity with a little bit of interest. What about their health? How much did their health impact which policy I recommended for them? Well, again, with this particular annuity with a long-term care rider, the money that's put into the annuity is used to pay for the first 30 months of care. The insurance company does not incur any losses until after the 30th month of care. And because of that, the underwriting is very lenient. Even though Cassie was uninsurable for traditional long-term care insurance, and Rod had very limited options for traditional long-term care insurance, they were both able to qualify for this Pension Protection Act, PPA, compliant annuity. As I've warned before, there are a lot of annuities that are sold as a solution for long-term care. A lot of them are really not so good. Most annuities are not compliant with the Pension Protection Act. There are a few that are excellent and that do comply with the Pension Protection Act. If you've been given information about buying an annuity for long-term care planning purposes, please reach out to me. Let me review it for you at no cost. Thanks.